Welcome to the Debt Doctor podcast, where we deliver the definitive prescription for navigating distressed real estate debt. I'm your host and America's most qualified debt doctor, Bymel. I've spent my career investing in, diagnosing, and reviving thousands of distressed real estate situations. The Debt Doctor prescribes proprietary remedies to help you identify, acquire, and monetize undervalued real estate assets. Each episode gives you insider access to the strategies top cohorts use to transform market volatility into double-digit returns. If you enjoy what you hear today, hit the follow button, subscribe so you don't miss an episode, and please share your support with a quick review. You can find me on the web at billbymel.com. Thanks for joining this episode of The Debt Doctor. I'm excited to introduce the world of the Debt Doctor audience to, let's just say, if I'm the Debt Doctor, this man is my scalpel. Erick Gonzalez, say hello to everyone.
Hello, world.
Erick and I have known each other, almost 20 years now. Those of you who've attended webinars of mine, you may have seen a few that Erick's attended, but mostly we keep him hidden behind the scenes. He's my secret weapon, sitting at the table, talking to borrowers, getting all the heavy lifting done.
I was 10 years old at the time, so you're still a bit older than me, Bill.
Yeah, you wish, pal. You wish. Well, and we really grew up in the industry together. I don't mean it like from a young age. We were probably in our late 20s, or whatever when we got in. But, I mean, if there's anybody, you fall into the class of person who is in the 10,000 hours category, someone who spent a lot of time looking at distressed debt situations in real estate. Is that a fair assumption?
Yep, that and then some.
So much so that when we started First Lien Capital, I was able to step away from really having the hands-on, day-to-day blocking and tackling that I used to do as an asset manager. Having a colleague like you that I know thought the way I did was obviously, made me sleep well at night, knowing that the shit was getting done.
And I'll tell you vice versa, Bill. What I noticed while you were building out First Lien and undergoing the, capital raise, capital management and that whole approach, being able to truly master both ends of the business, which is what's required, between asset management, portfolio management, money manager, investor relations. It's a very extremely tough task to really try to pull off by yourself, and that's why you need to have integral partnerships like we have that enables you to really conquer the world from all sides.
Yeah, I mean, let's dig into it a little bit. I'd love for this episode to also maybe we spend a few minutes giving a little bit of a glimpse inside the life of what we do on a daily basis, the conversations we have, maybe even, pull out a case study or two of files that we've worked on recently where we've had to get creative or we've had situations we've had to deal with. I have been doing it for a long time, and even now there's still new things that pop up, new angles, new tricks.
Yeah.
How do you stay up to breast with, I mean, when you're managing hundreds of assets and you've got it's got to be like, wrangling cats all the time.
It's one of the things that we always look at, that they may have the commonality that they're in distress, but there are no two situations that are identical. And you really have to have the abilities of understanding your positioning, understanding the positioning of the borrower, understanding the positioning of the asset, market, seasonalities, taking all that into context and trying to render the best decision that's going to enable you to to really hit velocity, right? And really be able to turn that asset over with its best performance. And like you just mentioned before, sometimes that's going to require you to take certain exceptions, certain discounts. It might not hit the exact model price point you anticipated, but to be able to get into an asset and recover from a potential pitfall and exit out of that by, either getting that loan to reperform or getting that loan to liquidate at a faster pace, for me, from where I sit, that's the business in a nutshell.
Right. I mean, that's really the key. And one of my other episodes that I just recorded was about the value of a loan. And a loan only has real 100% intrinsic value if it is performing, right? If it's performing as it was designed. So the minute that a borrower misses a payment, you have to go through a modification, or, that something else happens and they stop performing altogether and just don't even answer the phone, that asset, the entire balance of that loan amount, from a valuation standpoint, from the investor, from the bank's perspective, all of a sudden is called into question, because there's no, as long as the loan's not performing, it's illiquid. You try to sell it on the secondary market, you bring it to guys like me, they're going to pay you 50, 60 cents on the dollar. And so, all of our career has been about getting something to reperform. And when it
Yeah,
doesn't reperform, it's about getting that asset back in the quickest and cleanest way, allowing borrowers to exit with dignity, and then making a profit, hopefully from the delta that the discount that we paid.
correct. I mean, if you want to go into more detail as far as the market and how it could really throw a wrench to things, less than 2, 3 years ago, you even had some loans that were performing because they had such a low coupon that the value of that loan was actually less than you had on a defaulted loan.
Right.
So, it's very market driven. And, we've seen a lot of turbulent, headwinds in the last 5 years between COVID, rate hikes, inflation, things of that nature. So it's definitely been a ride, in the most recent years.
Let's talk about that, your experiences more recently, and maybe you can even dig into a couple of examples that come to mind. I think it was a lot easier when we were buying 7% mortgages into a declining rate market 10 years ago. And
Hmm.
those were underwater. We were paying 60
Yep.
cents on the dollar. We could discount, we could forgive debt, bring borrowers to even a lower rate, maybe 6%, 5%, make it more affordable, win-win, keep them in the house, get them reperforming, and then
Yep.
exit those as reperformers. But
And
if
now
some
that's flipped on its head, and now
Right.
you've got low rates, equity deals, deferments. So when you and I personally have enjoyed the abilities of getting someone who's not performing to be able to remain in the home, and more importantly, getting someone who's not performing to stop a net negative drag asset investment and get it to be on a performing basis so that we can trade it back out at a higher price point, when you're now dealing and attesting to loans that have these lower coupons and have these large deferments, and you lose that ability to be able to either capture that deferment into either some sort of capitalized modification and also bring the rates to a current market rate, which means basically you just lost a tool out of your tool belt. So it's a very big deal. It's a very,
Right. In
very
other
big
words,
deal.
if somebody can't afford a 3% mortgage or a 4%
Mm-hmm.
mortgage, and they
Yeah,
kept failing and modifying for 10 years at that low rate, then in today's market, we can't even give them that rate unless somebody's going to subsidize it. Like you said, that
correct.
loan is worth 80 cents on the dollar if you try to sell a 3, 4% mortgage in today's market, maybe less.
Maybe less, potentially less.
And for those
Yep.
that want a little bit more about understanding about what we're talking about, the value of the loan itself, you can look up an episode that I am posting about the secondary market and the value of loan portfolios. And I talk more about that. The performing loan on today's expected investor standard terms is what we would call a par loan, something that would trade it at the value of face value of things. Anything outside of what investors normally want today, which now that interest rates are higher, yield expectations are higher. Investors aren't going to buy 5% mortgages when they can get that 5% buying treasuries, you
Correct.
know?
Yeah,
and
correct.
that's the interesting scenario. So let's talk. Let's jump into a couple of the. What are some of the examples you've seen in the last few years that are different than
Well,
maybe?
listen, the secondary, as we've mentioned, and I've been on your podcast a few times where we talk about the business, the business usually falls into a third, a third, a third. What that means is, when you're taking down a pool of loans, you're probably going to convert a third of it into a reperforming basis. You're probably going to convert a third of it into some sort of deed in lieu to an REO, real estate owned by the bank scenario. And then the last third, for multiple reasons, you're going to go into a foreclosure to foreclosure sale, either to a third party or to a reverting back to REO situation. Where the business is brought in right now because you've got multiple things happening. A few of those things are that there's been such a high rate hike that a lot of these loans that receive these COVID forbearances and these COVID deferments with these low coupons really gives us, or I should say, gives us the lack thereof to be able to get that loan to reperform and allow these folks to try to save their houses because they basically have what would be considered the best option already in front of them. And if they're defaulting on that, it's apparent that affordability is not there. Where that has an impact on us is because now that borrower that we were able to get them to keep in the home and manage and get a net negative drag asset into a positive no longer exists.
Right.
So we either have to get creative with the financing, extending out amortizations and terms and things of that nature. Otherwise, that's no longer an option. Then that bleeds into the secondary option, which would be a deed in lieu with a relocation with dignity event, having some sort of dollar amount incentives being provided to the parties. That's also become a challenge because now all of the areas that these parties may have moved to either the prices in those areas have gone up, and of course, if they were to even be able to achieve even another finance position, those rates are now double and triple what they currently had. So now when you're trying to relocate parties, either rentals have gone up or the pricing has gone up, or you've had this mass migrations into these other states. So that's driven pricing up. So that presents itself as a challenge for us to even relocate them. And then obviously foreclosure is always a challenge. We've always viewed as foreclosure as a losing proposition, both for the investment and also for the borrower, of course. But it's something that we try to avoid as much as possible.
I guess if you're a credit union, if you can and you're balance sheeting loans for your own customers, then the yield on those loans is less important because you're never going to sell them. So maybe with your credit union clients, or if you picked up a few credit unions, or you could structure some modification programs that would work for them. They would just have to know that their that capital is limited in terms of its return. Let's talk about, like, not investors like ourselves who are already buying the debt at a discount. Let's talk about banks and credit unions, or bridge lenders, or investors, family offices who have bought these loans at par, who might have originated loans. And some of these folks I think you've had as your client, or you can even equate some of the guys that are competitors of mine who maybe overpaid for loans that were NPL. How do you deal with that? It feels like you have less optionality. How do you, when you're talking to a bank, or you're talking to a lender or an originator who's the one who's actually going to have to take the loss on an individualized basis? How do you navigate those waters when you have bank clients that you're doing?
I believe no matter who your investor is, the business could be quite simple. It's just based upon economics. You know, uh, uh, how long it's going to take you to execute, and what those returns look like. Whether that's a losing proposition or not, it really should not have an impact on the decision itself. Ultimately speaking, you're going to end up in the same place. You want to
Right.
get there as quickly as possible. And as the old saying says, you don't want to throw good money at bad. So, you want to make sure you're out there, taking your first loss so that you're not sitting here, sitting while the knife is still dropping. Um, no matter who the investor is that I'm working with, that's my model. My model is it doesn't matter if it was your money, it doesn't matter if you bought at a discount. Ultimately speaking, you're in a certain position with this asset. Here are your options as far as an exit strategy, and what can we hit with velocity and be able to get in and out as quick as possible, where it's going to be mutually beneficial for the borrower and for us, and it's going to be a win-win for everybody involved.
Got it. Yeah. And I'd like to drill it maybe into one example if you don't mind in a moment. But, you really hit on something there in terms of sometimes the first loss is the best loss, right? And you can't cross dollar average things. You got to look at each situation on its own. I would assume, I mean, I know from a specialty servicing point of view, and we're talking to investors or banks that are holding this paper marked at par, and all of a sudden it stops performing. They now are looking down the barrel of either having to capitalize that loan as non performing, do some kind of a TDR resolution, which is a kick the can down the road method. But often what we'll do is a two-pronged approach with bankers and investors where we'll say, listen, in 30 days, we could take this loan non-performing out to our broker channels and out to the buyers that we network with in secondary and provide a very indicative level of what the market will pay for that non-performing. If the market is willing to pay you 80 cents or more, take it and run. But if
Hmm.
you start getting bids in the 50s, 70s, 60s, the bank can't take that kind of loss
Yep.
without, taking a significant hit to their capital reserve. So one of the tricks that we've looked at and discussed with banks and with other investors is kind of like a loss share situation where you're coming in with X amount of capital up front as a special servicer partner. You'll buy them the loans and then you maybe share the proceeds above a certain level. Have you found success in things like that?
I have not gone down the route of going into some sort of JV profit sharing mechanism, really for the reason of, when you've got originators out there who are in a loss position, I find it to be a very tough conversation, and to get them sometimes to be realistic on what that loss is
Right.
presents its challenges to you. We've always done a success fee based type of fee schedule. What that's enabled us is to put our money where our mouth is. If we're not successful, then we're not charging. And in a business, as we all know, where you're getting charged every which way from morning till night, it's a fresh of breath air where you're out there not getting charged unless the parties are successful. And we're
Right.
very confident in our abilities to be able to go out there and, listen, there's no perfect scenario where you're going to go out there and execute in a week's time, right? It takes time. Sometimes it takes months, even years, where we're consistent and we're trying to, what I like to call being, passive aggressive, and trying to help the parties out. But, understanding the asset, understanding valuation, understanding markets, that all plays into it, because, you need to be able to make on very singular basis decisions, which in our business, just by virtue of the volume that it's based upon, is very challenging to do so.
Yeah. No,
So I'm
that's
not sure if that
absolutely.
not sure if that answers your original question as far as, dealing with these originators and credit unions and, their
Well,
mindsets.
they've got to be looking at pools that, either they're going to take a big loss or some loss,
Hmm.
and I would think it's probably harder for them to take these small losses along the way. But I don't know, what the bank's attitude is,
I
the
think I
investor's
think
attitude
the
is.
I think there's a very big difference between residential and commercial. You would have thought by now that commercial would have gotten way discounted back, and anybody who was holding that commercial paper would be willing to just let go of it, because, between carrying taxes and insurance on a commercial basis is a much heavier lift. We have not seen it. I think you would agree with me there.
Right.
Uh, on the residential side, I think part of what props that up, and I'm going to use that word prop very importantly, is, you've got such a lack of inventory out there where valuation is still running, and if you're sitting on, a bad debt of sorts, but the value of the underlying collateral asset is increasing, your mindset's going to be somewhat different.
Right.
Whereas if you start slipping into a declining market where values are dropping down, I think that's where you might see, all groups, not just credit unions and stuff like that. I think you'll see all groups be willing to unload, but ultimately speaking, you haven't seen that, right? You're still
Right.
seeing, very high demand. Again, it's very geographically based, but you're still seeing very incredible demand for real estate. And a lot of that has to do with court closures. A lot has to do with people can't relocate because they're already in a position to have a low rate. Even if they have equity, it doesn't make sense for them to sell because pricing has skyrocketed. Now you've got, inflation coming about, and you've got, turbulence in the markets. So, it's that wave that we're hitting is continually to ripple away. We haven't seen any, singularity scenario come about where the markets are really tipping over the scales, and valuations are being drastically reduced.
You think this is the year finally? What do you think?
I don't think so. Gave up on doomsday in
Yeah.
2018, 19,
Yeah.
so listen, there in our business, like any other businesses out there, you've always going to have, a life happening, life scenarios,
Sure.
unfortunately, some good, some bad. And there's always going to be a level of distress, and you've got a lot of larger institutional guys and players who are exiting the space because they're not able to deploy the kind of capital into the large trades. They
Becomes a
enjoyed
little
they
nicher.
they they enjoyed the era of low to zero interest rates. I don't think you and I ever in our careers ever had the experience of having rates in twos and threes and fours and fives. We've always been accustomed to having rates at,
Yeah.
8, 9, 10, 11, and 12, if not higher. So the business is kind of really playing into our favor right now. So we don't need there to be an onslaught. As a matter of fact, we don't
Right.
want an onslaught of assets out there. We really want a steady flow of trades becoming prevalent again, and enabling us to go out there and take down and manage, and really try to, our business, one of the pieces to it I love the most about is you're really helping people, right? You really have the ability to go out there, and not everybody out there is a bad character. There's just
Right.
some folks out there that fell in hard times, and if you can help them and it helps us, there's very few investments that you can really go into a distress scenario where it could be a win-win.
Yeah, that's so true. And because we have the asset-backed collateral, the collateral as our asset, it makes it an easier conversation for us. Because this is in many cases, whether it's a single-family home, a commercial, this is a lot of people's biggest investment in their lives. So they treat that
Mm-hmm.
very serious.
Yeah.
And for us to be able to help and work out and have people retain, we see it I am starting to see it a little bit in commercial, where bad more so on the bridge loan originations. I get a lot of commercial and residential bridge lenders out there just giving more money than they should have. And you're starting to see some backing up of that, some dislocation there. We know FHA loans that were originated in the last few years are all like there's like a greater than a 10%, I think like a 14% is the current default rate on that stuff. If that was 97% financing in the last few years and it's in default, that stuff's upside down. So there is, even with all the equity that exists in residential, and there is still some asset class, there are groups out there of assets that still need to be worked.
Oh yeah.
So,
I think majority of them do because you are still dealing with, human beings. You are still dealing with individualized scenarios and distress, and you got to be able to sit back and listen to those stories. And you hear one or you hear 1,000. Yes, it's very easy to get numb to the thought process of it, but you really do have to sit back and listen to them and see what you can do that to have a meeting of the minds and try
yeah,
to.
no, you're getting into something. I think that brings us behind the scenes a little bit as we talk about that because, we have heard we think we've heard almost everything. From
Hmm.
dog ate the homework to my wife took is living in the house and won't let me in, and but who knows,
Yeah.
or whatever the scenarios might be. You're right. People want to be heard. Borrowers want to be heard, and that's something that a lot
Yeah.
of servicers won't do, lenders won't do. And also, it's not only about hearing them to sympathize, it's looking for ways to solve the situation that works for both parties, right?
Yeah.
I would assume in many cases, it's about having a kind and frank conversation.
So, and I think that's what you're alluding to, which I'm going to agree with you. I think sometimes they need to hear why they don't qualify,
Right.
you know, and at least if you start going through some sort of debt to income ratios with the parties and they're starting to tell you that, 80% of their income is going towards the housing payment, it's something that I find, having that realistic conversation with them of, if you're spending this kind of money on your mortgage, you got no margin for any type of error or any type of savings. At the end of the day, all you're doing is paying an overpriced rent. But sometimes they want to hear that. They don't want to
Right.
just hear, you don't fit the criteria and therefore you don't qualify, and now they just have this question mark above their head. They need to hear exactly why it is and the rationale, and whether they accept it or not. That's not our job. At the end of the day, it is what it is.
Yeah. And having real frank conversations with people really do make the difference. Do you have any specific recent deals that we should talk about as an example without giving away borrower information, just to give an idea of how you and I look at anything? I know that kind of puts you on the spot.
I
So,
mean, it is challenging because we're dealing with different asset classes, right? Like, today we're dealing with a HECM loan, right? Obviously, that's going to have, drastically different parameters attached to it. We're dealing with a commercial loan after that. That's going to have drastically different parameters attached to that as well. But they all have that same rationale that I provided earlier, which is all it is an economic play, right?
right.
How do I maximize, what I need to do to get out of this loan at the quickest pace, make my returns, and go on to the next asset? How you achieve that and how you go about that, yes, those are the variables. And that's where you do need to have a firm understanding of all the parameters, who the parties are, what they're looking to achieve, what are the, what are the optionalities that you can possibly visit beyond maybe what their direct interests are. But the only way to do it is to have conversations. And I personally jump on calls with people, borrowers, all day long, attorneys all day long, to figure out what that meeting of the mind is.
Right, right, right. I mean, listen, like you said, it's a gift to borrowers to have a lender or special servicer, whichever hat we're wearing, to be there to talk and take that moment and customize your bespoke resolution. That's good for the lender. It minimizes loss. It's the definition of loss mitigation.
Mm-hmm.
And it's
Mm-hmm.
good for borrowers because it gives somebody the kind of thing that doesn't really exist a lot in America these days, which is real customer service, real attention to their specific individual needs.
Yeah.
You already predicted that we're not going to have a real estate crash. Certainly not in residential. I'd probably agree with you on that. But any other bold predictions for the rest of 25?
I wouldn't call it bold. I think it's pretty common. I think we're going to have some turbulent times. I think you're going to have some inflationary results from the tariffs, and that's going to create increased inflation, which is going to have people naturally pull back. But I think that'll be somewhat short term in the next 2 years. I think it's good for America to focus on America and production. I understand that we're the type of country that enjoys services, and that's a great thing. But I also think that I bought my kid and his friend a pie pizza last night, and it cost me $40 for a pie pizza and a soda. For the average family, I don't think that should be the case. So it's for the better good of all, and I think people need to understand that. But as far as having an impact and implication on the market, I think everything being consistent. I think that it's probably going to keep the markets where it's at, might flatten out. Obviously, you and I have seen areas like Florida where the mid to high rise condos and things of that nature are really taking and suffering losses of 20 and 30%. So DC is another area that we're being very concentrated
Mm-hmm.
on our focus as well. So yes, there's going to be pockets where you're going to see more distress. I think overall, though, I think the market's going to stay pretty flat.
I would love nothing more than to see something outside of real estate be cause the markets to normalize in other asset classes and really kind of bring about a re-strengthening of the dollar. Right now, this, like you said, the cost, you and I can afford that pizza. I don't know how the average Americans make getting by these days.
Yeah.
Just going to be more debt. Well, as I said, if I'm the debt doctor, not only are you the scalpel, you're the MRI machine. You're the whole frickin' hospital, bro.
Yeah. Yeah.
Thanks
Appreciate
for
that.
being with me, pal. We'll talk
Always,
soon.
always. Thank you, bud.
That's a wrap of today's episode of Debt Doctor. I enjoy bringing this content to you each and every week, and I really appreciate you tuning in. Remember to follow us so you get notified whenever new episodes release. If you haven't already done so, please share one of your favorite episodes with a friend, family, or colleagues. And if you don't mind, leave us a positive review on Apple, Spotify, or whatever your favorite listening platform might be. Until next time, thank you for investing your time with us on The Debt Doctor.